Well, good morning, ladies and gentlemen, and let me welcome you to the half-year results presentation for discoverIE plc. Now, I've been giving a brief introductory comment, and it will be brief, over a number of years now. And looking back at my notes, it's amazing how consistent some of the opening messages are. And I see that as a strength, which is a credit to both the company and the management team that we're following that consistent strategy. And I think you've heard me say, and Nick and Simon say, over the years, there are 4 key elements to that strategy, a strategy which we call a compounding growth strategy. So firstly, resilient organic growth. Secondly, robust and improving operating margins. Thirdly, growth accelerated through acquisitions. And then fourthly, strong cash flow supporting a robust balance sheet, which gives you the capability to make the investments to support the growth. Now, those are the 4 key elements, but particularly in challenging market conditions, economic conditions across the world, geopolitical as well, I think you have to actually look behind some of those elements at the drivers of those 4 key elements of the strategy, what I sometimes would like to think of as being almost super key performance indicators, super KPIs. So if we look at the resilient organic growth, I mean, what we're looking for there is in normal times to be doing rather better than the other participants in the industry, getting higher organic growth rates. But particularly in more challenging times when things are tougher, then we want to see resilience in that organic growth, and flat organic growth may well be a very good performance. And I suppose if you're looking at the super key KPI that we are always looking at to see whether we're achieving here, I think the one that you'll hear Nick refer to is actually the design wins in the target markets. We've got a set of 4 target markets which give us this resilience, which give us this higher than industrial average growth rate. And if we can be achieving significant design wins, that gives us the potential for future robust organic growth. Secondly, robust and improving operating margins. We can look at the operating margins, but what is it behind there that's driving it? The first thing is solid, robust gross margins. And those gross margins really prove that we are providing something to the customer which is valuable, which they're prepared to pay for. So good gross margins. And then looking at the operating efficiency, which allows you to move those operating margins up over time. And we achieve that through clustering the businesses, having small management teams who are looking at a set of businesses that have common technologies and looking at ways of improving the cost by working together and cross-selling. So that's the second element of margins. Growth accelerated through acquisitions. The key things that we're looking at behind that particular element of the strategy are firstly the pipeline of acquisitions, and Nick will talk a little bit more about the strength of that pipeline, but very importantly also return on investment from acquisitions. Anyone can spend money on acquisitions and get growth, but the key is to actually get value-enhancing acquisitions, and we can see that through the return on investment. And then finally, strong cash flow supporting a robust balance sheet, which gives us the freedom then to make the investments. So hopefully I've indicated some of those super KPIs, and we can now test Nick and Simon and see whether it stands up against it. I personally am pretty confident that you'll come away with equal confidence. Over to you, Nick.
Thanks, Bruce. Morning, everybody. Good to see you. Thanks very much for coming. Right, let's get into this. So, growth with efficiencies, good set of results. This is, continuing what Bruce has said, this is about keeping the growth going even in a slower growth environment. So, we grew sales over the last 2 years at around about 25% CER, not around, at 25% CER. This is obviously lower at 4% with 1% organic growth. But that's very good. I mean, we've grown a lot over the last 3 years, and we're holding those strong sales plus a bit. But perhaps better than that are the operating efficiencies that we've received. Simon will take you through some of that, but we've really achieved some really good operating improvements. Margins up 1.4 percentage points, 140 basis points to 12.9%. We're really pleased with that. Our margin target of 13.5% by March 25 is well in sight. Cash flow super, up 36%. Operating cash flow last 12 months with a 91% conversion. Super important to fund the acquisitions. Earnings per share underlying up 8%. And also worth mentioning, carbon emissions, they're now down in absolute terms by 45% since we started this in calendar year 21, so a really big reduction there. We have very, very strong design wins, and we have a very strong acquisition pipeline, both at record high levels. So those are the two drivers of growth, and they're in good shape. So all in all, notwithstanding a fairly uncertain sort of wider economic environment, we're on track. We've delivered a very strong set of first half results, and we're on track for the second half. This just summarises the four key strategic indicators. So operating margin on the left, our target now for the midterm is 15%, so that's around FY28. So we're really closing in on that well. We are internationalising revenue on the second chart beyond Europe. 42% of our revenue now is beyond Europe, and I'll show you some more details on that in the operating review. Target markets, well, down 1 point to 76%, but that's revenue, our revenue in the target markets, and it's down a tad because of the diluting effect of acquisitions as they come in. We've made 3 sort of meaningful size acquisitions in the last 8 months, and that has that effect until they get growing. And then carbon reductions I've already talked about. So with that, I'll pass over to Simon to go through the financials.
Thanks, Nick. Thanks, Bruce. And yeah, good morning, everybody. Okay, first up from me, it's the financial headlines. As you can see, it's been another strong period of profit growth, and that's given the various sort of headwinds that are out there, economic, interest, foreign exchange. So you can see profits up 17% at constant exchange rates. That's lifting our EPS. That's up 8%, and that's the growth differential there is linked to the higher interest rates and the stronger sterling that we've seen. Importantly, you can see that we've improved our operating margin significantly. That's nearly at 13% now, and we're maintaining our ROCE around that target range of 15%, and that includes, don't forget, 2 acquisitions that we did just before the period end. And I've introduced another metric here. This is return on tangible capital employed. I think it's ROTCE. That's 42%, and that reflects the underlying returns that we're delivering on the business. It's a very capital light structure, so 42% is a super bit of data. And I think all of these numbers here just support the model. It's about resilient revenues. It's about continued good growth in profitability, and it's about strong returns. More on all of those coming up. So first up, the sales. So it's a resilient set of sales. So sales up 4% on those high comparatives. So as Nick said, it's up 55% in the last 2 years sales, and it's actually more than doubled since 2018. If you look at that 4%, 1% organic, and that's across both divisions, and 3% from acquisitions. We've done 3 acquisitions in the last year: Magnasphere, Silvertel, 2J, and that's being offset mainly by currency. That's a strong sterling, particularly reference to dollar and Nordic exposures that we have. So certainly a very resilient set of revenues in these conditions. Lower growth sales, but we're still delivering that strong profitability growth and margin expansion, and that's very much linked to operational efficiencies that we've managed to deliver in the period. It's a combination of good control of costs through the period. You'll see that on the next slide, but also a number of initiatives that we've that we've been undertaking operationally. So the likes of moving production to lower cost countries, the likes of Mexico, like Hungary, and we've also been doing intra-business production, utilisation of other business capacity in the likes of the UK, in the likes of the US. And all of this sort of builds on our growth that we've delivered over a number of years. So we've delivered 26% CAGR growth since 2018, nearly 5% improvement in the margin. And you can see we're well on track, as Nick said, to hit the 13.5% in a year's time and 15% in the medium term. So this is I always think is a good representation of the business through the period. It shows profits 25.6 last year up to 28.6 this year. The three bars that you see on the left, that's our organic operating performance. The big standout there is gross margin. So that's lifted by 2 percentage points, which is a super job through those operational efficiencies we talked. Also some mix within that, and the OPEX. We've kept that down. The growth is only 5% in what has been a very high inflationary environment. So we're very pleased with that. And you can see that roughly three quarters of that profit growth is actually coming out of the organic, and roughly a quarter from acquisitions. So the chart's a good summation of our business model. So it's about organic growth, it's about operational efficiency, operational leverage, and it's about acquisitions. And hopefully second half you'll see a bit more action on the acquisitions. Next on to the two divisions. So strong growth in profit and margin with both divisions, as you can see in the chart here, that shows performance against last year at constant exchange rates. So in M&C, 2% organic sales growth. It's a mixed combination. Nick will talk about it in a bit more detail, but very strong in the US. Good strength, good growth in the Nordics, but offset by Asia, particularly through customer relocation, particularly to the US. So you're getting a movement in the growth rates. Strong gross margins in both divisions, very similar actually, 2% in both. And here you're sort of seeing only 3% OPEX. That's a really good performance to manage their OPEX base at that level. And through that you're getting a 16% growth in operating profits, a 1.8% pickup in margin up to nearly 15%, and that's up 2.5 percentage points in the last 2 years. So really, that division's really motoring on nicely. In S&C, 1% organic, 6% from the acquisition, that's mainly Magnasphere, which has been in for the full year. The 1%, again, a combination, strong US, good growth in the UK, offset again by Asia. But we're putting more costs in that division, 7% versus 3% in the other, and that's because that houses most of the newer acquisitions we've had, so we're just sort of building up the cost base in those new acquisitions. But you're still getting a 13% uplift in profitability and a just over 1 percentage point pick up in the margin. So strong performances from both businesses. Nick will give it a bit more colour coming up. This chart then is PBT, EPS. You can see the walk there from operating profit down to EPS of 19.2. Obviously, the big jump out is the 70% leap up in finance costs, and as you know, that's all linked to the interest rates. There's a little table down there. That's our three key borrowing currencies. We roughly borrow equally in those three currencies. I'm sort of guiding towards roughly a 9 million interest charge, for the year. Obviously, we've got the acquisitions we did at the end of the period and a bit of annualisation of the existing charge. So 7% growth in PBT, a little bit of a tax rate coming in 1% lower. That's modelling at the rate for the full year last year, 8% EPS, out of which we've paid a 6% growth in dividend. And you can see that EPS is all adding to what we've been delivering. So you can see the chart in the bottom right-hand corner. That's 21%, compound annual growth of EPS. So it's not too shabby. Cash flow, Nick remarked at cash flow at the outset. This, we always look at last 12 months cash flow. The chart in the top there just gives you a walk from the EBITDA of 64 million down to free cash flow in that period of 30 million. The bars on the left, that's our capital investments, working capital, just over 8 million into working capital, and that that includes some we'd sort of see it as sort of extra inventory that we can take out, and I think with supply chains normalised now, we'd expect to see that coming out, some of that coming out in the second half. So watch this space. CapEx just under 6 million. That's actually 1.3% of top line. We guide to around 2%, but typically we're sort of coming in under that. It's a capital light model. We don't have big sort of automated production going on out there. And if you remember that ROTE, that 42%, again it aligns to that. It's a capital light base. We're a capital light group, and that's driving some strong returns. And you can see it's generating strong cash flow. You can see that on the chart on the bottom. So 36% growth in operating cash flow, 26% growth in free cash flow. The difference mainly to do with the higher interest rates that we've experienced, and really good conversion, 91% operating cash conversion, 85% free cash conversion, so they're at or above our targets. And you can see the chart right at the bottom, which shows we're delivering strong, consistent cash conversion over 10 years. Averages sort of virtually bang on 100%. In terms of balance sheet, 111 million of debt on the balance sheet. That's 1.6 geared, so it's at the lower end of our 1.5 to 2 time range. And that should come down to around about 1.3 organically, assuming no were we not to do any acquisitions. And behind us, we've got a really, really strong revolving credit facility to support us. So all of this, it's our model. We're capital light, we're very cash generative, we're delivering strong returns. Next slide is just a reminder of our capital allocation policy. It's a simple one. We invest in organic, capex projects as they arise. We pay a progressive dividend, and then the balance of our free cash flow, we put into acquisitions. And you can see there's a chart there at the top, which is the capital we've used for the last 6 years, 186 million of free cash flow. Roughly 3/4 of that is going into those capital projects, and a quarter is going back to shareholders. So 420. So we're getting on for half of the capital we've used is now coming from free cash flow. So we're really pleased with that. And at the bottom you can see we're disciplined in terms of the balance sheet. We haven't gone over. We've never got near the 2 time geared level, despite that being the top. There's no need for us to overstretch the balance sheet. And finally, just a reminder of you of our KSIs and our KPIs. We've been reporting on these for the last sort of 10 years, so you can sort of see how we're getting on. Nick's sort of run you through the strong performances in the KSIs, and if you look at the KPIs and down the orange column, this year, we're delivering at or above target. We're pleased with that, particularly given the conditions. And if you look at the track record, we're delivering, strong sales growth, strong EPS growth, and as I said before, very consistent operating, strong cash conversion. So with that, I'll pass over to Nick for an operational review.
Great. Thanks, Simon. Okay, just to sort of step back from it all for a second, and this came out of some new investors that we've been talking to recently, and I thought it was worth highlighting for everybody, those that know us, who have known us for some time. But really, just to emphasise, we're a growth business. We focus on high quality markets that have above average growth prospects. We call them our target growth markets. They're markets also that are not highly cyclical, and we also avoid the highly cyclical markets, and that's been a deliberate decision taken sort of 12 plus years ago. So we supply into markets that grow better in good times and that don't have the same degree of negative downside cyclicality. And that means, for example, that we do not supply consumer electronic markets, we do not supply semiconductor equipment markets at all. The other key element of the markets we approach with the products that we offer is that the margins are very robust. We don't have products that commoditize over time. So we're able, and as you can see that through the results that we've delivered here and over the last 2 years, our margins at a gross margin level have been very, very robust indeed, and our operating margins, that has enabled with the operating efficiencies, the operating margins to develop very nicely. And all of that is making us more resilient in these weaker market conditions. So we're very pleased with that, but I just thought it was worth emphasising it's not by accident. There are two, if we cut everything back to what do we really do, there are two things that drive growth in this business, somewhat obvious, but I'll say it anyway. Organic growth, it's all about design wins, and acquisitions, it's all about building the pipeline of acquisition opportunities. Both of those metrics, which are obviously within our control, are at the highest levels they've ever been. So I'll talk a little bit more about both of those. So design wins, our design wins in the period are up 23%. That's our estimated lifetime value. That's the estimated lifetime of the projects that we're winning, to £190 million. And of those, 89% of those design wins are in our target growth markets. So that is, I always say, that is the single most important parameter of this business. If we did nothing else, we would focus on this because that would drive and create new revenues. And you can see in the chart there the degree to which that's grown. And it should have grown. At this stage in the cycle, when the cycle starts to slow, customers start to accelerate their design activity, getting ready for the new generation of product launches. So we should see the growth. And we've seen a very strong growth this period because in addition to that, there's been a bit of a freeing up from the previous supply chain bottlenecks and constraints that somewhat limited, due to component availability issues, limited some of the customers' sort of design projects. But that's all freed up, and hence a strong take-up. Behind that, there's a pipeline, an even larger pipeline, over £1 billion in opportunities that we've identified that we're working on with customers that some of that will come through over the next 1-2 years plus into further design wins. So keeping that design pipeline fully stoked is super, super important. We're an engineer-led model. Our engineers work with these customers. So this is the sort of the metric that they all work to around the business. And then the other driver of growth is the inorganic growth. It's the acquisitions. The top chart you'll be familiar with. That shows the EBIT ROI of all of the acquisitions that we've had for more than 2 years. And this is the value creation. It illustrates the value creation that we can achieve and that we are achieving by taking this long-term approach to compounding the organic growth. So we buy these high-quality businesses, we get them into the business, we sort of focus them in the areas that we want to be focused on, and that generates this above-market growth with returns. And as we touched on earlier, we've made 3 acquisitions in the 2 acquisitions in the period, plus one at the end of the prior period. Magnosphere, Silvertel, and 2J. Those are all businesses generating over 20% EBIT margins, and in aggregate, they're generating over 10% contribution to group EBIT. And then below that on the chart, on the slide, you can see this is just a sort of a visual representation of the fragmented market that we operate in. On the left, you can see the geographies, and along the top, and then down the side, you can see some of the technology areas we work in. And what that chart is showing is that, one, that it's a very, very fragmented market, and secondly, that there are most of the spaces on that market we have low or no visibility, low or no presence. So there's very significant opportunities for us to grow more by acquisition. And as is the trend these days, we've started to disclose the scale of our pipeline. So you can see there that we track over 400 companies, 250 or around 250 of those companies are identified targets. Currently 45 are in outreach and various stages of discussion, of which 15 are active, and there's over 100 million of active deal value there. And those represent significantly more than another 10% contribution to EBIT. So you can see from those two boxes on the right that we've got sort of 20% plus of EBIT contribution from acquisitions coming in, potentially in addition to that we're generating through the organic model. So obviously as we go into a lower organic growth environment, the contribution from acquisitions is going to become more significant. Pricing multiples are coming down. 8 is the new 10. And so these are starting to play a bigger part, whereas over the last 2 years, 2/3, 3/4 of the growth has come from organic growth. And that's the cycle at play. So this is a quick summary of our track record. I've been told we've got to sort of big up our story a bit, so here I am bigging up our story. It doesn't come very naturally. So sales are up 100%. This is going back to FY18, so that's the period starting April 17. Sales up 100% on ongoing sales in design and manufacturing, which is all our business is now. Operating EBIT, so this is the EBIT contribution from the businesses. In the second box, up 164%. The operating EBIT is group EBIT less the central head office costs. EBIT margin up almost 4 points to 11.5% last year, obviously 12.9 now, so even more, almost 5 points, and then underlying EPS up 140 points. So we're trying to deliver a consistently strongly growing business that grows above the market, and hopefully that convinces you that we are. And this is a new slide, which is one I just want to emphasize. So we talk about compounding organic growth. Our sales CAGR over the period since 2017 is 9% CAGR. But what the chart on the right here is showing is just what that really means in absolute terms. So we've indexed that back to FY17, which is the period starting April 2016. And you can see that in absolute terms there, over 7 years, the growth has led to a revenue in the target markets that is 82% higher than it was back at 2017. That's the effect of compounding higher than average growth. And then at the lower chart, you can see how that compares with the other markets, which are lower growth in absolute terms, and they're more cyclical. So the difference between those two markets is about 65%, something like that. So the compounding effect of organic growth is tremendous. And that's a really meaningful difference that our approach on these markets is delivering. And the other thing, actually, just to say, those who know us well know that we always talk about strong growth in good times, as Bruce did, strong growth in good times, plateau, strong growth again. And that's what the orange chart is also showing, that effect. A little bit more on the geographic sales. You can see in the top right, the pie chart shows that the UK, Nordic and North America now account for 54% of revenue. That's meaningful because they happen to be the higher growth markets currently, and North America growing very substantially. In the bottom left, you can see the growth rates of the various countries and regions. The notable standout is North America up 35% organically, Asia down 23% organically. Quite a few moving parts in both of those. North America is up for 2 reasons. One, because there's some great infrastructure projects, electrical infrastructure projects that are just pure organic growth. Our largest customer is in that space. Some very strong organic growth in rail infrastructure. And then also quite a bit of production moving back from Asia into the Americas, you won't be surprised to hear. So those two are factors of what's driving that. And then in Asia, 2 things going on there. China's down 9%. And actually India's down quite a bit more than that, because there's one customer that had grown very strongly last year that has overstocked actually, and so they've been, well, the demand has evaporated in this period, but that has meant that India is down by about, well, on an underlying basis, India's down by about 20%, but if you exclude the large customer, then India is actually up 8%. So, one of the reasons our operating margins increased so much was partly because our gross margins are resilient at a headline level, our pricing power with customers. We play a very straight bat with our customers. When costs go up, we pass those through. Simple as that. And so that has held the headline level pricing firm, as indeed it should do. The second contributing factor is we've had a bit of a tailwind from, as the semiconductor supply chain issues have eased, that's led to some of our higher margin businesses improving. And thirdly, the efficiencies, which has been quite a significant factor this period. So, when we buy a business and we bring them into a cluster, we look for ways to do stuff more effectively or more efficiently. So, for example, 2 years ago, we bought a business with a facility in Hungary. We've now moved 2 and are in the process of evaluating moving a third business, some of their production, to there. So we've moved production from the UK and from the Netherlands, and we're looking at moving some production from Germany to our facility in Hungary. And that has the effect of just a pure efficiency gain, just a pure margin gain. We've also moved production around the globe to make the sourcing and supply chain routes more efficient. We've moved some production from the US into Mexico. We've also moved production from the UK over to the US, and that also has the benefit of then qualifying for Made in America status. And thirdly, we've also started to use, with greater sort of scale and geographic reach, it turns out we have facilities around the world that can make products and solutions for some of our other businesses. And we are doing some intercompany production for some of our other businesses because it makes good business sense to do so. So from a production optimization point of view, we really have seen quite a few significant benefits this period. The other aspect that's not mentioned on this slide but is also important is that we've been able, if this is production optimization, we've also done some engineering optimization, which again is the cluster at work. So, for example, in our sensors cluster, as we've bought businesses, we've gained some engineering expertise that has enabled us to re-engineer or modify perhaps products for some customers to give them a technical advantage and at the same time give us a margin advantage. So that sort of enhances our position with the customer and increases our margins. A little bit on the geographies. I mean, not a huge amount to say on the divisions. There's not a huge amount to say here. They're fairly similar, and Simon's covered off most of it. Magnetics and controls. You can see down the bottom the list of acquisitions. You can see that the geographic split is quite similar to the group split, with a sort of strong UK, Nordic, North America bias now, and obviously North America is really becoming a very much more significant proportion for us in both divisions, and similar Asian and American growth characteristics. Sensing and connectivity, again, some very similar, stronger UK presence, but overall the UK, Nordic, North America angle is accounting for a little over half of the revenue. A lot of acquisition activity, a lot more acquisition activity has been going on in the sensing and connectivity space, which we're very pleased with. It's been a good time to buy businesses such as 2J most recently, because they are very, very well positioned to benefit both from the structural growth trends, but also from the cyclical market recovery. And the geographic split also quite similar. Order book has normalised. We're back to 5 months of order book. Actually what that is there are 2 businesses that are running with slightly longer order books because customers in those spaces themselves have long order books, and they're still a little bit mindful of the pain of the component shortages that they experience. So they're running with longer order books with us. That's fine. But the rest of the businesses are back to about 4.5 months. So we're really back to normal. And so now, what we're seeing as we came to the end of the period is order rates picking up, back to year-on-year growth, sequential growth and year-on-year growth. And we've seen a little bit of that as we go into the new post-period end as well. So what that all tells us is that the supply chain, the inventory correction, at least in our space in the industry, has run its course, and customers are starting to place slightly larger orders to get back to where they need to be. So the outlook, as I say, orders returned to growth since the first half. We don't yet know, obviously, what the organic growth rates are going to be for the next 6-12 months. But it's good that the orders are returning to growth. Supply chains are back to normal. We've got record design wins and the strongest pipeline of acquisition opportunities we've ever had. And those two factors are what positions us well for the growth as we go forward from here. So we're confident of delivering a good set of results for the second half as we go into that, but also beyond. Whatever the market does, we're well positioned to do as well as we can. We've got the right focus on the right drivers.